Hey, what's going on YouTube? And welcome back to Tech Conversations. I'm your host Guillermo. It is April 4th. Hope you're all having a great weekend so far. Let me know in the comment section below if you think tomorrow will be a red day or a green day in the stock market. Now in today's video, I want to talk about a very powerful strategy that can double, triple our money. And I want to talk about what types of stocks you want to be using with this strategy. So before I jump into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Let me know in the comment section below if any of you guys like using this options trading strategy. So the goal from this strategy is to profit from a huge price change. And here's what makes this very powerful. We don't care if the price change is up or if the price change is down. So in other words, it could go either way. We really don't care. And so we're looking for high volatility here, guys. And so what are the ideal scenarios for this strategy? So there's a couple of different. So let me give you guys kind of a few here. So one of them is going to be event presentations. So think of Palantir. Palantir has demo day coming up. This is an event that could cause Palantir to move quite a lot. Could be up, could be down. And again, the cool thing here is that we really don't care. Other things include FDA announcements or some sort of, product development. So for example, if we take a look at ticker symbol CEMI, Cambio Diagnostics, on Thursday, they announced that they came out with a diagnostics test to differentiate between COVID-19 and the flu. As you can see, this moved the stock 60% after hours. Now, this is a penny stock, so it's going to move a lot more than regular stocks. But still, you get the idea. These are types of events that make the stock move a lot. Now, the other thing, of course, is earnings report. So these are events that, with good news can send the stock flying. With bad news, it can send the stock plunging. So in this situation, in this scenario that we're going to talk about today, we're going to be focusing on earnings report. So the ideal thing here is to find stocks that have earnings announcements coming up. And one thing you always want to do, of course, is to check past earnings to see if it has a history of moving a lot up or down after the earnings announcement. So always check history, past history, when you're doing any of these types of strategies here to see how the stock has kind of reacted in the past. And so one stock I want to use is RPM International. And again, the reason is that they have earnings coming up here very shortly, April 7th, pre-market. Now, ideally, we'd like to enter this strategy a couple of days prior to the earnings announcement, and I'll talk more on why. But here is the stock we're going to be using. So make sure that you've enabled options trading in your settings, or else you're not going to be able to trade options. Once you've done that, we can go over to the options for the stock. So again, RPM International. So here's what we're going to do. We're going to be buying an out of the money call, and we're going to be buying an out of the money put. So let's start with our out of the money call. And so out of the money will be, of course, where the strike price is above what the current share price is. So any of these up here, I'm going to click on the $95 strike. So we're going to buy this call, this out of the money call right here. It's going to cost us $1.08 per share. Remember, there's 100 shares in each one of these contracts. So it's going to cost us about $108 to buy this call. Now we're also going to buy an out of the money put. These are going to be the ones where the strike price is below the share price down here. And so I'm going to choose the $90 strike price. I'm going to buy this out of the money put here. Again, this is going to cost me $1.10 per share. There's 100 shares in each one of these contracts. It's going to cost me about $110. So as you can see, the name has changed up here. This is a strangle, more specifically a long strangle. It is very similar to the straddle that we talked about a few days ago, but there are some differences, and maybe I'll make a video later on where I talk about the similarities and differences between these two strategies. But as you can see, this is going to cost us, if we take a look here, we only want one contract. This is going to cost us about $218. Now, the reason I mentioned that you want to enter this strategy few days prior to the earnings announcement is that because remember, with earnings, the closer you get to earnings, the more implied volatility starts to go up on these contracts. For example, if you take a look at this put that we're buying here, implied volatility is only 31.9%. As we get closer to earnings, implied volatility is going to start to go up because usually, again, with earnings, the price tends to move. And so implied volatility starts to go up because we're expecting the price to move the closer we get to that earnings announcement or any type of big news that might move the stock. And remember, implied volatility affects the price of these contracts. Anytime that implied volatility goes up by 1%, the value of this contract will go up by whatever this Greek vega is times 100, right? Because this is per share, so we need to multiply this by 100. So it's basically going to be $6. So if this goes up by 1%, this contract will go up by $6. If this goes down by 1%, this contract will go down by $6. And so that's why you generally want to enter this a couple of days before, because implied volatility is going to start to raise and get higher the closer you get to the earnings announcement, which of course will mean that the value of the contracts will also increase. So anyways, with that being said, let's go over to the options profit calculator and let's actually kind of chart this to visually see kind of what our profit or losses will be depending on what the date is, depending on what the price of the stock is. So here we are on the options profit calculator, very useful. So you're gonna find this under these this advanced section here. And again, this is a strangle, a long strangle. So let's click on here. So Strangle calculator, again, we enter the ticker symbol here. We're using RPM right now. And by the way, this is just an example. I am not telling you to enter this trade. I'm just using the stock because it has earnings coming up and it kind of makes more sense for this example here. So what we're going to do again, we're going to buy an out of the money call and an out of the money put. We'll buy the exact same strangle that we did in the other page here. So again, make sure that you're choosing the correct expiration date up here. So April 16th, that's correct. Calls are on the left, puts are on the right. And so for the call here, this is the call. As you can see, we chose the $95 strike, which is right here. So we'll click here. And then for our put here, we're going to buy an out of the money put. And again, make sure your expiration date is correct. Calls are on the left, puts are on the right. We chose this $90 strike put right there. So again, it's going to cost us $218. And so for now, for the price range, I'm going to do 83 to 102. The reason is that I'm going to assume that this stock moves 10% after earnings. And again, I don't care if it's up, I don't care if it's down, as we'll see here. I'm just going to assume it's moving 10%, and that would put us at these two prices. So let's take a look here. So here is what this graph will look like. But let's first focus up here on the returns. So our entry cost is $218. That's also our maximum risk. So our risk is defined here. We know how much we're losing or how much we can potentially lose right from the start. That's going to be $218. And we're going to talk about here where that would be. Our maximum return is infinite on the upside because, again, theoretically, the stock could go to infinity. It's not going to, but, you know, there is that possibility always. But as you can see down here on the bottom, on the downside, the stock can only go to $0. So it is capped down there. And we'll kind of take a look at how much you could make if it did theoretically go to $0. And as you can see, we have our break evens at expiration. So 87.82, 97.18. So let's first talk about how much we're going to make if this does move 10% after earnings. So again, earnings is on April 7th pre-market. So we could cash out of this on the 7th. So if this goes up by 10% on April 7th, it's going to be $9.25 that it's going up by, which would be at about $102. So on the 7th at $102, we would make $501 or about a 230% return. If it goes down by 10%, it would go down by about $9.25. So it'd put it about $83, $83.25, which means we'd still make $470 or 216% return. So as you can see, we don't care whether the stock goes up. We don't care whether it drops after earnings. All we care is that it moves and that it moves significantly. What we don't want is for this stock to really not do anything after earnings, right? If earnings were announced on the 7th and this stock, let's say, drops $1 to 91, 50, As you can see, we'd actually be down, $38, $40 or so. And we certainly don't want it to just trade sideways. So again, the sooner the stock can move up or down quite a bit, the better. The longer you start to wait, the more it has to move up or down for you to make a profit. Now let's focus on expiration date here, kind of talk about what could happen, different scenarios here. So on expiration, if the stock price is between the strikes of these two options here, so it's between 90 and 95, you're going to lose your max amount of $218. That makes sense because if the price is between these two, that means these both are expiring worthless, right? Your put would expire worthless, your call would expire worthless. Now let's take a look here. We do have break evens that they give us here, 97.18, 87.82. So if on expiration date, the price is at 87.82 or 97.18, you're breaking even, you didn't make any money, you also didn't lose any money. Now, if the price is under 90, but if it's above 87.82, you're going to lose some money, but you're not going to lose all of your money, right? As you can see, if it's, for example, 89.25, you'd only lose 143. If it's at 88.50, you only lose $68, and so on. If it's below 87.82, then you make partial profit. You start to make money there, right? I shouldn't say partial. You make money because there really isn't any cap here, but the same thing goes on the upside, right? If it's above 95 but below 97.18, you only lose some of your money. So if it's 96.75, you only lose $43. If it ends up being above 97.18 on expiration, then you make money. So that's kind of the way it works here, guys. Again, the thing we don't want it to do is to just trade sideways, or else you're going to end up losing all of your money or most of it, right? So again, this is the strategy I wanted to talk about, guys. If you have any questions, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.